Welcome back to Silver&Metal IQ, the channel where we cut through the noise and expose what's really happening in the gold and silver markets. I'm Peter, and if you're here because you're confused, nervous, or even shaken by silver's recent pullback, then listen very carefully. Because what I'm about to explain could completely change how you see this market. Let me ask you something straight up. Are you seriously selling your silver just because it pulled back from $84? Have you actually convinced yourself that a tiny pullback means the bull market is over? Because if that's the case, then you're reacting exactly the way the market wants you to react. What we just witnessed was not a crash. It was not a trend reversal. It wasn't even a real correction. It was a microscopic liquidity grab, a deliberate shakeout designed to scare weak hands before the real move begins. And here's the proof. Today, January 6th, during the New York trading session, silver surged back to $80, just like that. The so-called correction ended almost as fast as it began. That dip below $77 was the trap. The move back above 80 is the confirmation. The next leg higher has officially started. Before I drop the knowledge that most people never understand until it's too late, you need to understand where I'm coming from. I wasn't introduced to markets later in life. I was born into them. Literally. My father was one of the top traders in the United States, the kind who moves markets instead of reacting to them. My mother is from Hong Kong, raised in an Eastern system that thinks in decades, not quarters. I grew up watching how power really operates in financial markets, how narratives are created, how fear is manufactured, and how wealth is transferred from the impatient to the prepared. And the playbook never changes. First, panic is injected into the crowd. Headlines turn bearish. Social media fills with fear. People start screaming about RSI, overbought conditions, and necessary corrections. Retail sells, stops get hit, leverage gets wiped out. And while all of that chaos unfolds, the real money steps in and buys everything. Then, once supply has been absorbed, price is launched violently higher. History doesn't just rhyme. It repeats with embarrassing precision. There is a dangerous myth in markets that says an asset must correct, that prices cannot rise continuously, that momentum has to cool off. That is complete nonsense. If the entities with real capital and real influence decide an asset is going higher, it goes higher. Period. There is no law of nature that forces a correction. That idea exists solely to shake retail traders out of winning positions. And silver right now is the perfect example. This move is not about charts. It's not about indicators. It's about power, scarcity, and control. We are standing at the edge of a historic monetary shift, a restructuring of the global financial system that began the moment the dollar was detached from gold in 1971. That system is now breaking down, and hard assets are reasserting themselves as real money. China understands this. They've been preparing for it for decades. They are not reacting. They are executing. They are accumulating physical gold and silver at a pace never seen before, not for speculation, but for survival and dominance in a post-dollar world. And that is why silver is not expensive at $80. It is cheap, it is mispriced, and it is being accumulated aggressively by the most powerful players on Earth. This pullback was the final gift. The window is closing, and if you're still focused on short-term noise instead of long-term reality, you're going to miss what comes next. Stay with me, because in the next part, I'm going to show you who was buying during the dip, why it matters, and why silver's move toward $100 is not speculation. It's structure. Now let's talk about what really happened during that dip, because this is where most people get it wrong. While retail traders were panicking, refreshing charts, and convincing themselves that silver had topped, something very different was happening behind the scenes. The entities that actually control price were doing the exact opposite. They were buying, aggressively, quietly, with precision. When silver dipped below $77, it triggered a cascade of stop-loss orders. This was not accidental. Liquidity was needed, and the fastest way to get liquidity is to scare weak hands into selling. That sell-off created a brief window where large players could step in without chasing price higher. This is how markets have always worked. The illusion of a breakdown creates opportunity for accumulation, and that's exactly what we saw. Look at the speed of the recovery. Silver didn't drift back up slowly. It snapped back. That tells you everything. If this were a genuine trend reversal, price would have struggled, consolidated, and failed multiple times. Instead, buyers absorbed supply instantly. That is the signature of strong hands. That is what accumulation looks like in real time. This is where the idea of a silver cartel comes into play. For years, silver has been suppressed through paper markets, derivatives, and futures contracts that represent metal which doesn't physically exist. The goal has always been to manage price perception, not reflect true supply and demand. But that system only works as long as physical metal is available to backstop the paper. And that backstop is disappearing. Physical silver inventories are draining globally. Vaults are being emptied. Refiners are running at capacity. Industrial demand continues to rise, especially from solar, electric vehicles, and military technology. Unlike gold, silver is consumed. Once it's used, it's gone. And that creates a problem for a system built on infinite paper supply. What's different this time is that the East is no longer playing by Western rules. China is not buying paper silver. They are buying physical. India is not speculating. They are stacking. These countries understand that control over physical resources equals power, and they are acting accordingly. While Western markets argue over technical indicators, the metal itself is quietly moving east, ounce by ounce. This is why the futures market is losing credibility. Paper price can be pushed around temporarily, but it cannot override physical reality forever. When too many contracts stand for delivery and there isn't enough metal, the game changes. Premiums explode, spot prices disconnect, and eventually, confidence in the paper system collapses. What you are witnessing right now is the early stage of that process. The dip was a stress test. The market passed. Supply was absorbed instantly. Confidence returned just as fast. And now the narrative is shifting again. From fear back to disbelief. People are already saying, "I'll wait for the next pullback." That's dangerous thinking. In strong bull markets, pullbacks get shorter, shallower, and eventually disappear altogether. Smart money understands this. They don't wait for perfect entries. They build positions during chaos. They buy when sentiment is weakest. And they hold while everyone else second-guesses themselves. That's exactly what happened during this so-called correction. Silver is not behaving like a weak asset. It's behaving like an asset under accumulation. And once that accumulation phase ends, price does not move politely. It moves violently. What makes China's role in the silver market so critical is not just the volume of metal being accumulated, but the intention behind it. This is not speculative buying. This is strategic positioning. China has learned from decades of observing Western financial dominance that real power does not sit in paper promises. It sits in control of physical assets. Silver, because of its dual role as both a monetary and industrial metal, is uniquely valuable in this strategy. For years, Western markets have treated silver as an afterthought, a volatile cousin of gold that could be manipulated through futures contracts and algorithmic trading. China, however, sees silver as infrastructure. Every solar panel, every electric vehicle, every advanced electronic system depends on it. By securing physical supply today, China is insulating itself from future shortages and price shocks tomorrow. This is long-term thinking, and it stands in sharp contrast to short-term Western trading behavior. The Shanghai market has become a critical piece of this puzzle. Unlike COMEX-style markets, where most contracts never result in delivery, Chinese exchanges are far more physically oriented. When demand rises there, it directly impacts real-world supply. Metal leaves vaults, inventory tightens, and premiums begin to form. This is why spot prices in Asia are increasingly dictating global direction, even if Western charts haven't fully caught up yet. This shift is quietly breaking the traditional pricing model. For decades, silver's price was discovered in New York and London, largely disconnected from where the metal was actually being used. That system is now under stress. As more physical metal flows east, less remains available to satisfy Western paper claims. The result is a growing imbalance between what futures markets say silver is worth and what buyers are actually paying to obtain it. The gold-to-silver ratio exposes this distortion perfectly. A ratio above 100:1 is not a sign of silver weakness, it is a sign of extreme mispricing. Historically, such levels have only occurred during periods of intense stress or manipulation, and every single time, they have been followed by violent silver outperformance. The ratio does not normalize gently, it snaps back. What's important to understand is that this snapback doesn't require a crisis to begin. It only requires a loss of confidence in paper pricing. Once enough participants realize that futures prices do not guarantee delivery, behavior changes overnight. Contracts are rolled less, physical is demanded more, and suddenly, the leverage that allowed price suppression works in reverse. This is where backwardation becomes critical. When spot silver trades above futures, the market is sending a clear message. Metal today is worth more than metal tomorrow. That should never happen in a well-supplied market. It happens when immediate availability is scarce, and scarcity is the one variable no central bank or trading desk can print away. Western investors often dismiss these signals because they are trained to trust charts over fundamentals. But charts are reflections of behavior, not causes. When physical buyers dominate, charts follow, not the other way around. And right now, physical buyers are in control more than at any time in recent history. The most dangerous assumption being made today is that silver will behave the way it always has. Markets don't repeat, they evolve. The rules that applied in a world of abundant supply and low industrial demand no longer apply in a world of electrification, de-dollarization, and geopolitical fragmentation. Silver sits at the intersection of all three. This is why silver's current price should not be viewed as stability, but as compression. Pressure is building, energy is being stored, and when that pressure is finally released, the move will not ask for permission. It will reprice silver to where it should have been all along. The reason suppression efforts are starting to fail is simple. They rely on abundance, and abundance no longer exists. For years, silver price control worked because paper markets could create unlimited supply at the click of a button while physical demand remained manageable. That balance has now flipped. Industrial demand is accelerating, investment demand is returning, and available inventory is shrinking at the same time. That combination is lethal to any system built on synthetic supply. Automated selling, which has long been used to cap silver rallies, is also losing effectiveness. These algorithms are designed to trigger during moments of market stress, linking silver to broader equity sell-offs. When stocks fall, silver is dumped automatically, regardless of fundamentals. This creates the illusion that silver is a risk asset rather than a monetary metal. But illusions only work as long as participants believe them. Increasingly, they don't. What we are seeing now is decoupling. Silver still reacts to equity volatility, but the reactions are becoming shorter and weaker. Each sell-off is met with faster buying. Each dip is absorbed more aggressively than the last. This tells us that the pool of willing sellers is shrinking. Weak hands are already gone. What remains are buyers waiting patiently for opportunity. Cash-settled futures contracts have made the disconnect even worse. When contracts are settled in cash instead of metal, they remove pressure from the delivery system in the short term, but they destroy trust in the long term. Market participants begin to realize that owning a contract is not the same as owning silver. And once that realization spreads, paper demand evaporates while physical demand explodes. This is where capitulation begins, not among buyers, but among short sellers. Short positions only work when price can be pushed lower indefinitely. But when physical demand places a hard floor under the market, shorts are forced to cover. And when they do, buying becomes mandatory, not optional. This creates vertical moves that no technical model can predict in advance. The repeated failures to break silver decisively lower are not random. They are messages. The market is telling you that suppression has reached its limit. Every attempt to push price down now requires more effort and produces less result. That is the definition of exhaustion. When exhaustion sets in, reversal is not a matter of if, but when. What's critical to understand is that this process does not unfold smoothly. There will still be volatility. There will still be sharp drops designed to shake confidence. But these drops no longer change the underlying trend. They only transfer metal from impatient holders to disciplined accumulators. And once that transfer is complete, there is no supply left to suppress price with. Historically, silver does not move gradually out of suppression. It explodes. It reprices violently in a matter of weeks, sometimes days. And by the time mainstream attention arrives, the opportunity is already gone. This is why the calmness you see right now is misleading. The market is quiet because it is tightly coiled. The bigger picture is that silver is transitioning from a traded asset into a strategic resource. Governments, industries, and institutions are waking up to the fact that without silver, modern economies stall. That realization changes everything. Price becomes secondary to availability, and when availability becomes the priority, price has only one direction left to go. To truly understand where silver is going, you must stop looking at it in isolation. Silver never moves alone. It moves in relation to gold, currencies, and confidence in the global monetary system. And right now, all three are shifting at the same time. That alignment is rare, and when it happens, it produces historic outcomes. Gold is already signaling what silver has not yet fully expressed. Central banks are buying gold at the fastest pace in recorded history. This is not speculation. Central banks do not chase momentum or trade charts. They prepare for systemic change. When they accumulate gold aggressively, it is because they no longer trust the stability of fiat currencies. Silver always follows gold in these cycles, but when it follows, it overshoots. The gold-to-silver ratio tells the story clearly. Even after silver's massive move higher, the ratio remains historically elevated. This means silver is still undervalued relative to gold. In previous cycles, when this ratio collapses, silver doesn't rise slowly, it surges. The rebalancing happens violently because silver is thinner, less liquid, and far more sensitive to demand shocks. Now, layer currencies on top of this picture. The dollar is not strong. It is merely less weak than others. Strength today is relative, not absolute. Every major currency is being debased simultaneously through debt, deficits, and monetary expansion. When all currencies weaken together, people don't run to another currency. They run to real assets. This is where silver thrives. Unlike gold, silver is both money and necessity. It cannot be replaced. There is no substitute for silver in electronics, energy transmission, solar panels, medical equipment, and advanced weaponry. When prices rise, demand does not fall. It accelerates. That breaks traditional economic models. High prices don't destroy demand. They expose shortages. This is why silver shortages don't announce themselves with headlines. They reveal themselves through delays, premiums, and quiet hoarding. Fabricators secure supply months in advance. Governments lock in contracts. Institutions buy quietly, avoiding price spikes until positioning is complete. By the time the public notices, supply is already gone. Another critical factor is confidence, or more accurately, the collapse of it. Markets run on belief. Belief in paper promises, belief in settlement systems, belief that contracts will be honored. Once doubt enters that system, behavior changes instantly. People demand delivery. They refuse cash settlement. They withdraw metal from vaults. That's when paper markets break. We are already seeing early signs of this shift. Delivery demand is rising. Vault withdrawals are accelerating. Registered inventory is declining. These are not opinions. They are observable facts, and they all point in the same direction. Physical silver is being removed from the system faster than it can be replaced. At this stage, price becomes a lagging indicator. By the time price reflects reality, positioning is already complete for those who understood the signals early. This is why waiting for confirmation is dangerous. Confirmation arrives after the move, not before it. Psychologically, this is the hardest phase. The market feels unstable, loud, and contradictory. Some days feel euphoric, others terrifying. This emotional volatility is intentional. It exists to exhaust participants and force poor decisions. The people who succeed are not the smartest. They are the most disciplined. Silver is not asking for belief. It is demanding understanding. Understanding of history, supply chains, power structures, and human behavior. Those who grasp these forces don't panic on pullbacks. They recognize them as structural pauses in a much larger repricing process. The final phase of this move will not be rational. It will not be orderly. It will be driven by fear, urgency, and competition for remaining supply. When that phase begins, strategy shifts from accumulation to protection, from buying to holding, from price targets to preservation. Everything you've heard so far leads to one unavoidable truth. This is not a normal market cycle. This is a transition phase between two systems. One is collapsing under the weight of debt, leverage, and broken promises. The other has not fully formed yet, but its foundation is already visible. Scarcity, physical ownership, and real value. Silver sits directly at the center of that transition. In moments like these, the biggest mistake people make is focusing too much on price and too little on position. Price is what you see on the screen. Position is where you stand when the system shifts. Throughout history, fortunes were not made by predicting the exact top or bottom. They were made by being on the right side of structural change. Silver is not rising because of hype. It is rising because it is being pulled from both ends of the world at the same time. Industrial demand is accelerating. Military demand is non-negotiable. Energy transition demand is exploding. And monetary demand is returning as trust in fiat erodes. These forces do not cancel each other out. They compound. At the same time, supply is rigid. Mines cannot ramp production quickly. New discoveries take years. Recycling cannot fill the gap. This creates a condition where demand responds instantly, but supply responds slowly. When that imbalance persists, prices don't move linearly. They gap, they overshoot, they shock. This is why volatility will increase, not decrease. Sharp pullbacks will happen. Violent rallies will follow. Media narratives will flip daily. Analysts will contradict themselves. This chaos is not a sign of weakness. It is a sign of transition. Weak systems fail quietly. Strong repricing events are loud. Your job in this environment is not to be perfect. It is to be prepared. Prepared mentally for volatility. Prepared strategically for uncertainty. Prepared structurally with assets that do not rely on promises, counterparties, or faith in institutions that are already strained. The people who struggle the most are those who try to trade this environment emotionally, chasing every move, panicking on every dip, selling strength and buying fear. This market punishes impatience and rewards conviction built on understanding. Physical silver is not about getting rich overnight. It is about surviving and preserving purchasing power through a monetary reset. Gains may come, and they may be dramatic, but that is a byproduct, not the purpose. The purpose is insulation from systemic risk. As the paper system tightens, control will increase. Regulations will expand. Capital flows will be monitored more closely. Access will become restricted. What is easy to buy today may not be easy to buy tomorrow. History shows this pattern clearly. Assets that protect people are always discouraged before they are restricted. When confidence finally breaks, and it always does suddenly, not gradually, the scramble will not be for yield. It will be for safety, for tangibility, for certainty, and by then, silver will not be debated on charts. It will be competed for in real supply chains. This is why discipline matters now, why education matters now, Why understanding the difference between money and currency matters now. Silver is not a trade, it is a statement that you understand what is happening beneath the surface. The window does not close with a bell. It closes quietly, then all at once. Those who prepared early will already be positioned. Those who waited for certainty will be paying premiums, if they can find supply at all. The choice is not urgency versus fear. The choice is awareness versus denial. Systems change whether people are ready or not. The only variable is who adapts in time. Financial disclaimer. This content is provided for educational and informational purposes only and reflects general market commentary, not personalized financial advice. I am not a licensed financial advisor. Precious metals markets can be volatile, and prices may fluctuate significantly. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. Past performance is not indicative of future results. You are solely responsible for your financial choices.